Hi, I'm Luann Fulmer here with Eric Heckman of Heckman Financial. And earlier on our show, we discussed how some of the powerful benefits, or what some of the powerful benefits of a Roth conversion are, and that there are windows of opportunity for making them. But here's the deal. A lot of people don't realize this. A poorly executed Roth conversion can potentially cost you more money than it saves. So, from accidentally pushing yourself into a higher tax bracket to triggering surprise Medicare premium increases, there are several landmines that you need to avoid. So, let's get into that. Eric, tell us what some of the most expensive mistakes are that you have seen people make when they're attempting Roth conversions on their own.
Yeah, no, there's definitely a lot of things that people don't think about. I mean, I actually was doing a live event with somebody, and we he came up to me afterwards, and he was saying how he did a $500,000 Roth conversion,
Wow.
and he was single, so that was the top tax bracket he was
Right.
hitting. And why didn't you just do, like, 150 or so over
Hmm.
3 years? He goes, "Oh, I just wanted to get it done." It's like, okay, well, you paid a lot more tax. So that's one of those things that really people mess up on. The other one is what you kind of alluded to, good old Aunt Irma, as I like to
Yeah.
call her.
Right.
There's Uncle Sam and then Aunt Irma, and
Hmm.
Irma is a acronym for this calculation to figure out, did you make, quote, "too much money?" And so, what is too much money? Well, right now it's it's around 106 for single, and double that for married, so 212. But what happens is, if you are over 65 and on Medicare, and you make over those dollar amounts, they start jacking up your Medicare premiums, and they can go up 400%. And if you're married, that's for each of you. Doesn't matter
Hmm.
whose income it is, it goes up for both of you. And that's fine if you sold a whole bunch of stock. That's fine if you sold a house and had a capital gain. But if you're doing it from a Roth conversion, then that means that's really a planning error. And we do taxes here at Heckman Financial for our clients. Our professional tax software, and not all of them, the ones I've seen, none of them do this calculation. Now, we actually do have some special tax planning software that does include this, because of the other sad part is you don't see it until late. So, say you did a high Roth conversion in 2025. Well, you don't do your taxes until April, right? So the
Hmm.
government doesn't really get to see that until the end of 2026. And so for 2027, that's when they'll jack up your Medicare premiums. So there's a 2-year delay. So whatever year you have that big, huge increase, it's going to mess up things later. So, so that's one of the other. It doesn't mean you don't do it. It just means you want to know that dollar amount and how much that's going to cost you, and then you have to say, okay, does this make sense to do, or maybe we should do a little bit less. And so typically, for most of our clients, we go under that limit, just
Hmm.
to avoid it if we can.
Yeah. Yeah, so that Medicare premium issue does really catch people off guard. And so, Eric, why don't you explain how people, you kind of already have, but a little bit deeper, how people should think about balancing Roth conversions with the income based considerations?
Yeah, well, I mean, it's just like anything. What you're trying to do is you're trying to level out the taxes. You're just trying to get, a little bit more even, and not have these huge spikes and such. So, what you're trying to do is kind of fill that. Think of each bracket as a bucket. So, you're in the 10%. Everybody has all the brackets. It's a lot of
Yeah.
times people think if you hit 24, all your money's 24. No, it's 10, 12, 22, then 24. So, if you can fill up each one of those, and if you're going to be in the 22% bracket when you have RMDs, and you're right now in the 12, then fill it up to that level. But you also have to watch out, because more Social Security taxation kicks in.
Hmm.
So sometimes a $20,000 Roth conversion can increase your income by 35,000, because you have more Social Security tax. So it is one of those things where you really have to run the numbers, and the only way to do it is actually run it with tax planning software. It is
Hmm.
so dangerous if you just try to guess this; it's
Yeah.
not going to work well. So,
Yeah.
so you need to know that, and then again, like that IRMA calculation, that's a sneaky little one, because it doesn't show up on your tax return, and it doesn't actually show up for and almost 2 years later, and then all of a sudden you're really annoyed that this cost you a whole bunch of money. Now, it does only go for that 1 year. But of course, if you did another Roth conversion and then and at the end of that year, you found out this thing's messing you up, you might have a couple years of higher premiums, right? So,
Yeah.
so again, that's one of those things you got to watch for.
Okay. And then, Eric, it sounds like, the key is having a long-term plan rather than making these decisions every year, like you're saying. So can you walk us through your strategy and what a well-designed multi-year Roth conversion strategy looks like?
Yeah, well, it's if you've done a great job of saving and built up a lot of money, there's probably no way you're gonna get it all converted. But what we're trying to do is at least slow it down. At least, it's you don't want to be putting gasoline on the fire while you're trying to put it out, right?
Right. No
So,
way.
so you don't want to build up the tax fire even bigger where it eats up more and more of your money. So yeah, maybe it's only 50,000 a year or 25 or 30 or whatever it is. And, maybe you've got 10 years before you have required minimum distribution. So you do have some timeline to, keep doing these conversions, but your other money is going to still continue to grow, right? So it's not going to solve it by any means, but if you can knock down a whole bunch of taxes, in retirement, then that's going to come off those highest top brackets. And so that's really the key is if you can lower those last dollars in that are the most expensive tax dollars coming out, that's really what we're shooting for. And so, yeah, so that's one of the things that people really need to be paying attention to, and again, that's why we set up the toolbox. So that way they can get a lot of information like, am I paying too much in taxes and social security in retirement, social security timing. There's a lot of great things in there. Will my money last as long as I do? A copy of my book, Worry Less Wealth, and a way to set up a time talk with me, Eric Heckman. So all you got to do, text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below on the podcast.
And thank you so much for spending part of your day with us today. We're so excited to have you with us. Get some guidance from this awesome man, awesome team at Heckman Financial, because they certainly have seen it all and they can help you. So I want to make sure that I mention that. So, gosh, this level of strategic planning that includes, projecting your taxes in retirement, and you got to coordinate Social Security and Medicare, come up with all these different scenarios. I mean, people just don't know where to begin. And that's why we are here, because Eric and his team do this every day. So Eric, explain, just talk about how you navigate all these moving parts in a retirement plan, and you help people create this comprehensive Roth conversion strategy that actually works for their situation.
Yeah, well, I mean, that's the key is having the planning. I mean, one of the problems with my industry is most people who do financial planning, they say they don't do tax advice. Well, every single thing you do and with money is tax related. So I
Right.
just always think that blows me away. That's like, how
Yeah,
could you not do tax advice?
I know.
So it has to be incorporated. That's why I'm licensed to do taxes. That's why I have a full-time tax person on staff, is to help people figure that out, because of lots of times the tax person says, go talk to the financial advisor. The financial
Okay.
advisor says, go talk to the tax person, and then nobody's helping you at all.
Right.
And as you said, it's very, very complicated.
Hmm.
With some good software, with some good tools, yeah, we can easily do the analysis. But again, it does take a little bit process. So we first meet with people to kind of find out what their situation is, what their worries are, what their concerns, and then we go through the blueprint. And then at the end of that second meeting, that's actually when we ask if they want to be a client or not and have us help solve the issues, or they want to try to do it on their own. So, again, I would definitely have people, suggest if this is their situation, hey, give us a call. You can even also text the word visit to 800-454-1184. If you just want to set up a time to talk, again, text word visit 800-454-1184, or click the link below on the podcast.